Okay, so let's dive into this stack of source material you've shared. Some really detailed notes here on, the principles of effective trading.
Absolutely. And what's interesting is they go beyond just the usual charts and technicals. They really dig into um, discipline, risk management, and getting a real handle on market structure.
Right. So our mission for this deep dive is basically to sift through all this and pull out the really essential knowledge because, well, the sources seem pretty clear on this.
Mhm.
Being a consistently good trader, it sounds like it's less about some magic indicator and more about managing yourself and, understanding how the market actually works fundamentally.
Exactly. And that self-management, that discipline, it actually starts outside trading hours, according
Wow.
to these notes.
Yeah.
They make a big point about taking like full breaks.
Full breaks, like really switching off.
Yeah, especially weekends, no peeking at charts, no thinking about trades, just disconnect,
Right.
recharge.
Okay. And then there's this idea of becoming your own boss. The sources talk about needing a really clear written plan, like instructions from a manager.
Right, like a boss telling an employee exactly what to do.
And the employee part of you just has to execute that plan no matter how crazy the market feels in the moment.
Precisely. That plan needs details.
Hmm.
Working hours, specific rules, guiding principles, the works. For those 5 market days, the employee just follows the blueprint. It really highlights that internal split you need for control.
Okay, now risk. This is where the notes get pretty sharp. They flat out say setting daily or monthly profit targets. That's just the wrong way to go.
Yeah, that jumps out, doesn't it? So if you're not aiming for a specific profit number, what are you doing?
Right.
And the notes pivot straight to risk. You set a maximum loss limit instead. That's the focus.
Thinking in terms of like acceptable drawdown.
Okay.
For personal accounts, they suggest maybe what, 1 to 5% daily loss limit and maybe 15% overall for the account.
Something like that, yeah. The exact numbers might change. Maybe for a prop firm, it's different, but the core idea is the same. Manage the downside first, rigorously.
Makes sense. Now, what about market structure? The notes seem to prioritize this heavily.
They do. They boil it down to 3 key things, and crucially, in order of importance. First, number 1 is the trend.
The overall direction. Okay,
Second is level. So support and resistance zones, your key price areas.
got it. Trend, then level.
And third is slope,
Mm.
which is really about momentum, the strength or speed of the price move.
So understand the main flow, identify the barriers, and then look at how fast things are moving. That's the hierarchy they present.
Yes, and they insist you stick to that order.
Mm.
If the trend says buy, you basically ignore sell signals from levels or slope.
Mhm.
Trend rules. A good trader, the sources say, blends insights, sure, but always respects that main structural priority.
Okay, this kind of leads naturally into the psychology side, doesn't it? The classic problem.
Mhm.
Why is it so much easier to let losers run than winners?
Ah, yes. We take profits way too quickly and cling on to the losers.
Why do we do that?
Well, the source links it back to when you first enter the trade. You wait, you get confirmation, you enter.
Hmm.
And immediately you might see a small loss, right? Floating negative.
Yeah, that initial drawdown feels bad.
Exactly. It's
That's
uncomfortable.
right.
So when the trade finally ticks into positive territory, even just a little bit, there's this huge sense of relief.
Yeah.
And you grab that small win, lock it in, avoid the pain.
And then inevitably the market zooms off towards your original target right after you got out. So frustrating. The notes kind of imply market makers might even use this psychology.
It suggests they can capitalize on it, yeah. Using swings to create that emotional pressure.
Yeah.
But the key takeaway, according to these notes, is how this psychology ties directly to your actual account growth.
How so?
Your growth depends on 2 things. Win rate that comes from your strategy being effective, matching the market structure,
Right, the technical side.
and your risk to reward ratio, your RR. And that, the notes stress, is heavily, heavily influenced by your trading psychology, how you manage those exits.
Ah, okay. So being truly effective isn't just having a good strategy that fits the market, though you obviously need that for your win rate. It's also managing your own mind, that employee, to let the RR actually work out.
Exactly. The source suggests the wrong trade isn't always the entry. Sometimes it's staying in a loser too long because you abandoned your plan. You didn't stick to those market priorities.
So even if a strategy is statistically solid, say it only fails like 6% of the time in certain conditions,
Yeah.
you still have to execute it with discipline, manage the risk, manage the emotion, follow the plan, not just react.
That's the crux of it.
Okay, so let's just quickly recap the main threads here. Discipline is key, right? Taking proper breaks, having that solid written plan, the boss employee thing.
Mm-hmm.
Then risk management, focusing strictly on maximum loss limits. not profit targets. That was a big shift in perspective. Definitely. Understanding market structure means trend first, then level, then slope. Stick to that priority.
Yep. And finally, mastering your own psychology, particularly around trade exits, because that's absolutely vital for your risk-reward ratio.
So it's the strategy aligning with the market, plus you managing the human element. Both have to work.
Which leaves us with maybe a final thought for you, the listener.
Mhm.
If managing your own psychology and discipline is really such a huge part of this whole trading game,
And the sources seem to hammer that point home.
right, then how do you actually practically build and maintain that effective boss and employee relationship within yourself over the long haul? That feels like the ultimate challenge these notes point towards.